Welcome to Channel 17, the Town of Colonie Government Channel.
Hello and welcome to The Money Factor. I'm Richard Naylor, your host. Our topic today is the current difficult investment climate. And here to talk about that is Frank Marchesini from Edward Jones. I want to welcome you back, Frank. You've been here a couple more times, and it's always
nice to be back, Richard. Thank you for having me.
The last time you were here, we were just in the throes of AIG, and we've passed a lot of markers since then. But we're still looking at difficult times.
We sure are. It seems like there's been a lifetime of events since last October when I was here.
And a lot of words thrown around that sound dramatic, like toxic assets. And
a lot of newly created words. Stimulus.
I know your customers could supply us with all the questions we need because we all have questions. What do we do? And I thought we could start with the idea of what's cheap. I know I've wondered, you see something that used to cost 50 and now it costs 12 or 15 or 20, and it might be a big oil company that you think, wow, what could be wrong here? Are stocks cheap, and what do you say to somebody who asked you, should I buy? Is it cheap?
Well, the word cheap is certainly a subjective term. Stocks are clearly across the board inexpensive, and that is primarily for two reasons. Stock valuations are really driven by expectations of future earnings. And if those expectations have been dampened or decreased due to our current economic downturn, that's going to be reflective in stock valuations. But also, stock prices are a function of supply and demand. And when people want to buy, they're going to drive the stock price up. And we're just not in an environment right now where people are, willing to step in the arena because of the uncertainty out there. So, for the long-term investor, I would say they're clearly inexpensive. But for someone whose time horizon might be much shorter than that, less than 10 years, 5 years, or then there's more risk, and certainly there may not be a value there for that individual.
I would think the ideal person would be somebody with a lot of money who just woke up and said, I need to start investing. Maybe I should invest in stock. And compared to buying 2 years ago, unless stocks are just suddenly no longer any good, that would be a fantastic situation.
Well, that's, certainly you hear the term cash is king. I mean, people view that two ways. If somebody came in with a lot of money right now, they certainly can pick up some great values out there. But I'll also submit to you that even folks that don't have a lot of money, the ones that are systematic investors, they put into their 401ks, they're actually benefiting greatly right now by the fact that a lot of people have exited the market. The retirement plan savers are getting much more bang for the buck right now. And again, if history serves as a guide, you're doing the right thing by investing in down markets for long-term growth.
Are we still pretty strong on the dollar cost averaging, or?
Absolutely. I mean, that whether it's a high market or a flat market or a down market, dollar cost averaging, although it never guarantees you a gain, it lowers your average purchase cost. So it's an effective strategy no matter what market you're in.
Okay. Maybe of all the sectors, maybe we're not going to talk about housing right away, but of all the sectors that seem to be in the news, the financial services sector has certainly got some spotlights on it. Of course, housing is part of that, but how is that looking? Is it cheap? What's going on there? What's driving things?
Well, boy, I could almost have a whole show on that. But clearly the financial sector has driven this entire downturn. And the fact is that although there's a lot of work to be done there's a lot of uncertainty. Their balance sheets, there's still how to deal with the questionable assets. We've seen an unprecedented consolidation. Companies that were stalwarts in the industry are no longer here. Banks have merged.
Lehman Brothers, wow.
Yeah. I mean, Bear Stearns. There's still a lot of work to be done in that sector to get it well. A lot of the government actions have been proposed to get the financial sector stronger, because that really, there lies where the confidence will be increased across the entire global market. You've got to get the financial sector strong again, or signs of it strengthening, before everything else tends to take shape. And there's clearly a lot of work to be done still. But there are things that are looking like they're improving. There are signs out there.
Well, Geithner came out with a few plans in the beginning, and everybody said, so where's the plan? But then he came out with something else, and now things look like maybe they're giving him a chance.
Sure. Well, there's, again, this government action continues to be somewhat fluid, but there's a couple of main things that they've done. They're going to be implementing what's called a stress test, and it will take a look at financial services companies, banks primarily, and assess the risk with varying economic conditions. If economic conditions hit a worst case scenario, what kind of additional capital will they need? That process will then, again, build more certainty into what these banks may need. The other important part of this is removing the toxic assets from the balance sheets, because those assets have uncertain valuations right now. They're not liquid. And as the valuations continue to decline, banks have to then further write off. And it's just a drain on their whole financial position. So the proposal to create a public-private partnership to remove those assets and then essentially spread the risk across private investors, that seems to be a very positive thing. That's gotten a lot of press last week. Again, depending on how well it's implemented and managed, that remains to be seen. But conceptually, it seems like the right thing to do.
So that might get the banks willing to lend, or is it just that they can't lend because they've got all this on their books that they don't know what it's worth, but if they mark it down to what people are paying for it, it's puts them out of their ratios, and now they're in big trouble?
Exactly. I think it certainly supports having cleaner financial statements. The investors will then be able to better ascertain what a company would be worth moving forward. Certainly, it'll free up capital that a bank may be right now not willing to lend because they have to reserve against those assets. So it just, again, there's a lot of positive benefits that could arise from this if it's done properly.
So they're doing a stress test. Does that mean that we're going to have to wait until the test is done before we know what the company is worth? Or are people analyzing the companies now and saying, I'm pretty sure this company is going to do better than that company?
Well, I think that's going on continually. The problem is the conditions just seem like they change. And for somebody to really get their hands around it is difficult. And one of the reasons, that's why you see so much volatility in the financial sector. When you see bank stocks going up 30% in a day, that just suggests that there's some piece of news that didn't exist the day before that the market latches onto. When companies report much higher than anticipated earnings, that is positive. But again, that is a surprise, and we could use a few more positive surprises and not the negative ones right now.
Right.
But the bottom line is there's uncertainty out there that has to be I guess cleared up with time.
So maybe people are tending to be patient until we get a little further down the road?
Well, I think patient, or just people, if you're talking about an individual investor, I think there's a lot of folks that are somewhat paralyzed, not sure what to do. There's trillions of dollars right now sitting on the sidelines. People are, for whatever reason, waiting to get back in when they feel better, when they see signs of recovery. But usually, the market will precede the economic recovery, again, on average by about 6 to 8 months. So, as quickly as things start to look better, you may have missed a good part of the rise.
Yeah, I think I've heard things like 20, 30% possibly of the rise could be in the first month.
That's correct. And I'm not going to sit here and pretend to predict the bottom of it all, but if you just look at how quickly we had a rebound in March, since March 9th, the Dow bottomed at about 6,500. Within about 3 weeks, we gained over 20%. And if you take your eye off the ball, you could miss it. That's why we recommend people just, prudently stay the course and stay invested as a rule, because it's difficult to time these things, if not impossible.
And I guess everybody has to realize that life isn't 100% safe no matter what you do.
Well,
and doing nothing can be a mistake, right?
There's, again, the rules have been kind of rewritten here over the last several months, and, the term safety has completely been redefined. But, doing things like being properly diversified and having your eggs spread across different types of assets, those are time-tested principles that, again, may not avoid disappointment. Clearly, we've had a pretty damaging market, but over the long term, that's the best way to ensure the best returns over time. Is just how well your assets are allocated.
It seems like in the past we were looking at a 5-year time period where you would say, if you're 5 years away from retirement, your stocks could be relatively higher. And now I've heard people and seen averages printed where they're looking at 10-year periods and showing things really haven't failed to improve over 10 years, while you could find 5-year periods where they were pretty flat.
Well, this past I'll say 6-month period, in our business, we tend to look at things in rolling 10-year averages, typically. And this is the worst 10-year performance of the S&P, the general market, since 1926. If you had invested in, this is
dramatic.
I'll say unprecedented, but we haven't seen this kind of pain in quite some time. Most folks not in their lifetime. But the market averaged a negative 1.25% return over the decade. So that would certainly lend itself to, redefining what long-term means. But what's interesting is that even in those decade-long periods where the market hasn't performed very well, the following decade we've seen pretty nice and sizable returns. So, for younger investors, there's some real opportunities. The trick is really about the folks that, the pre-retirees or the retirees right now, really got whacked pretty well. And, how to manage that and how to recover from that is a tricky thing, because you certainly don't want to take on more risk to make up for the loss. But at the same time, being overly conservative isn't the right answer either, because ultimately that money does have to grow. People are living longer, and you've got to keep ahead of inflation. So having your money sitting in a money market right now earning 0.5% is not the answer.
Right.
And that's the challenge right now.
Yeah, I was looking around this past week trying to find a place to put some money that got more than 1.5%, and it's not so easy unless you're willing to tie it up for 2 or 3 years.
That's generally what's going on right now. But there are some pretty attractive opportunities out there. You just have to you have to understand how they fit into your portfolio and again, understand the risk and the considerations.
Let's go back to the portfolio again, and we'll get to diversification. But before we get to other vehicles, just a couple words maybe on stocks themselves. How do people diversify in stocks?
Well, there's a couple of ways. Certainly, the first and easiest way to look at diversification is just having different companies, but break it down even further. Look at different industries because every industry sector. I'll give you some examples: industrial, energy, consumer products, healthcare. They all perform differently depending on where you are in a business cycle. And I'll give you an example. When you tend to be in a downturn or a recessionary period, as a rule, consumer products companies tend to hold their value better because the idea is that no matter how bad things get, people have to eat and buy groceries.
I may let my razor get a little duller, but I'm going to need more.
Right. And at the same time, cyclical companies may tend to lag because they're hitting a bottom part of their business cycle, and therefore they tend to fall out of favor. So again, owning companies in different industry sectors is one way to diversify. You take it a step further, and then you add the geographic component. You also want to have some of your assets diversified overseas, Asia Pacific, Europe, domestically. Again, part of the problem we've had with this downturn is that it really hit every entire market geographically. And in some cases, the international markets were hit a lot harder than the U.S. market. So there really wasn't any safe haven if you were in the stock market at all, for the most part.
Right. Yeah, I know that Germany has been number one in terms of exports, and because the export market has collapsed perhaps more than anything, even Germany is suffering.
Oh, sure. I mean, Europe, China right now, they had experienced 8% average growth rates. Their growth rate is way down right now. But the one thing that I can say is that as a collective, global market, governments are trying to get their arms around stimulating their economies, and we're trying to be more collaborative in that quest for turning things. So, again, as much as people may have an issue with how government does get involved, from a jump-starting standpoint, it seems like it's necessary, but eventually the markets will take over.
I forgot to ask you about nationalization, because we were talking about government involvement. You mentioned the banks, the stress test, possible need to intervene. How does that nationalization affect the stock?
Well, you've clearly already seen that. That's happened primarily with the two largest banks, Citigroup and Bank of America, that have taken much more of the TARP money, the government capital. Their stock price has plummeted, and primarily because that's just diluted the shareholder value. The common stockholder is the lowest in the priority of who gets paid, ultimately. So those actions have really diluted the shares. Further up the line are the bondholders and creditors and suppliers. Clearly, if they have to take more money, that will have a more dilutive effect on the shares. And certainly, ultimately, the common shareholders right now are bearing the bulk of the risk. For the folks that are buying the stocks, where they were a month ago, there isn't a whole lot more downside. But the ones that have bought the stocks when they were at their traditional, 5-year highs, they've borne that risk, and it's going to take a while, possibly, to ever get to those levels again.
So that's a tough one. We mentioned how low your bank interest is, 0.5%, 0.8, maybe 1 if you're lucky. So how do you diversify today?
Well, again, everybody's situation is individual. I never like to give advice to everybody as a rule of thumb, but clearly you're not getting return on your current capital in the short-term environment. I'm talking money market CDs. The reason people had put money in there to the extent they have was more about return of capital, not return on your capital. They were just fearful, just wanting to preserve what they have, and really not caring secondarily about what they were getting. But I think at some point, that sentiment tends to change, and as people, get more comfortable about what they see, but also realize that they do need to generate some return, that money will tend to flow out to other asset categories that are providing much higher returns, and compared to the risk you're taking, a much better value. So again, stocks, bonds, as a rule, having a mixture of those, having money liquid, having enough to cover emergencies, whether it's 1 year, 2 year, a lot of that depends on the predictability of your income, are both spouses employed? Those types of things will determine how much you need to keep liquid. But anything more than that right now, more than what you really need, you're missing an opportunity out there to generate more return on your money.
You mentioned bonds before, municipal bonds also. Could we talk a little bit about bonds
Sure.
and what role they might play? How are they looking right now?
Well, right now, as a rule, bond prices have been down. Now, if you, again, use history as a guide, typically what you see in a market cycle that is when stocks go down, there tends to be a flight to quality or a shifting of money to more preservation-oriented investments like bonds, and those values tend to go up. Because of the nature of what created this downturn was really uncertainty about debt, bonds as a rule, unless they were government bonds, were completely bypassed. So you saw bond prices come down. And right now there is still a devaluation of bonds. Prices are lower. There is some concern about risk with corporations that might have been less than of the highest quality. In a recession, it tends to put more duress on their business and maybe a higher risk of default. Those, whether they're real or perceived, weigh on the pricing of bonds. But right now, you can get bonds that are paying, over 5% in the municipal market. In the corporate bond market, we were routinely seeing over 6%. And again, I wouldn't, go hog wild and go out and throw all my money in bonds, but to pick up bonds in a market like this would be a prudent thing, because what they provide is stable and predictable income in the long term. And for folks that rely heavily on their savings for income, if they've dumped everything into the short-term market right now, they've taken drastic pay cuts. And that's problematic for folks. So as much as people want to have things absolutely liquid and safe and all those good, warm and fuzzy things, they've seen their incomes reduced. And it makes sense to look at things like muni bonds and corporate bonds to see how well they fit.
Well, 5 or 6% doesn't sound very bad right now when we've lost 30 to 40% on our stocks.
Well, I agree, and for those that have capital and have cash, it's a great opportunity to be looking at those things. But But again, I always want to preface my comments that you have to make sure you understand the risks, the considerations, and just make sure it's appropriate for you as an investor.
Let's talk a little bit about the dynamics of bonds. I used to find it rather counterintuitive how they worked. The value of the stock, of the bond would go down, and the rates would go up, and I would be like, this doesn't make any sense.
Well, if just to step back simply, a bond is basically a loan type investment. You're loaning capital to either a corporation or a not-for-profit municipality or a school district, and in exchange for that loan, the issuer of the bond is going to promise to pay back your principal at some point at the end of the life at maturity, and also pay you a fixed rate of interest during the life of that bond. Now, how bond values can fluctuate, there is a lot of dynamics, but one of the basic dynamics is that as interest rates change over time, the value of your bond will fluctuate as well. And basically the reason is this: if interest rates were to go up, your bond is being valued against new bond issues that are being issued at that time. And if somebody can get a higher rate on a new bond versus yours, why would they want to invest the same amount you invested in yours? Your price will be discounted. So ultimately, it's about equalizing returns on bonds, whether they're new or outstanding. So that's one of the most important things, is that bond values do fluctuate based on interest rate changes. Your payment is always fixed. So it's just about what you see on paper if you go to sell the bond in the marketplace.
So if you're just interested in the income and you're happy with it, it's what you bought.
Exactly. That's exactly the way that you look at it. And that's difficult for a lot of investors because they see that fluctuation. And what we've seen recently is bonds have fluctuated much more significantly than what they've had in the past. And that's created a lot of concern for bondholders because you inevitably think, well, gee, what's wrong with my bond? And there really may not be anything in terms of the credit quality of the bond, but a value is what somebody is willing to pay for it at the time. And if there's more sellers than buyers, then you're going to see a price decline.
And I think you suggested by another comment you made that the supply and demand on bonds is also tied to people's feeling of risk.
Absolutely. A bond is just like any other type of asset. And clearly we've been in an environment really across the board, with the exception of, I say, treasuries, government-backed bonds, that there has been more sellers than buyers. And so for someone that's willing to invest and commit capital, there have been some great opportunities here over the past several months.
Now you can get corporate bonds, you can get municipal bonds. How do people decide between the two?
Well, the biggest difference is that, as a rule, corporate bonds are fully taxable. The interest off of the bonds, you pay federal and state tax if you live in a state that you pay income tax, which in New York State, obviously, we do. Municipal bonds are, as a rule, they're all federally tax exempt. And if you buy a bond in the state where you reside, if you buy a bond issued in the
fund,
state,
right?
Yeah, or a fund. You don't pay state income tax as well if there's a state income tax. So, if you were to buy a New York State dormitory authority bond, you pay no state or federal tax on the interest off the bond.
Which could be a 20 or 30%, maybe
That's right.
more premium.
The more tax sensitive you are, clearly the more municipals would work to your advantage. So whether someone should buy a corporate or a municipal, their tax bracket is a factor, but also there's risk differences that need to be considered as well. So no one is better than the other, but again, it just depends on the suitability for the individual.
That's about covers it, I think. Nobody's going to make any prognostications on the show. I don't. Also,
Certainly I'm not.
I know you're not. I don't believe that anybody really knows, or they would be wealthier than selling stocks, right? They would simply be doing the right thing themselves. But any last words for the investor who maybe is saying, "Oh my God, I could have sold at 14 and I didn't, and then I could have sold at 9, and now look at me, I'm at 8."
Well, I would say this. Over the last several months, I've been recommending to folks, do not give up, do not take your foot off the gas pedal on your retirement funding. As you mentioned earlier, dollar cost averaging. I've heard folks absolutely abandon 401ks, young investors, because the market's down. And this might be the first time they've experienced a down market. And that's really the wrong thing to do, because they're going to experience several more between now and the time they ultimately retire and start to draw from that. This is a cyclical business. There always will be cycles. This happens to be a very painful one, and one that a lot of us haven't gone through yet. But it doesn't mean that there isn't a solid reason to invest capital, and you just have to rethink and review your goals, your time horizons. I'd recommend, if you don't work with someone, work with a professional. Just having that person to talk to, I think, adds a tremendous amount of value. But it's been a difficult market, and really one that has been completely widespread in terms of damage. But other than that, just be patient. Markets do return, and we just got to wait for this thing to recover.
I guess people are they feel more pain when they lose something than they feel joy when they get something.
Absolutely true. Greed and fear are very powerful emotions, and the markets are driven by both. But fear overcomes greed. And I found that people have very high risk tolerance when markets are up, but as soon as things start to turn south, it changes. So
it's kind of backwards.
It is. But that's the nature of this type of it's a human process, and it really is a lot of driven on emotion.
And it helps to understand it, I think, no?
Well, you learn a lot about human psyche and human nature, and when you're involved in this on a daily basis, that's for sure. I've learned a lot about myself, on how I respond to things like this. So,
well, it's always good to have you on the show.
Well, Richard, it's a pleasure. I appreciate you having me back, and I really enjoyed the discussion.
Hopefully next time we can have a more positive climate to talk about.
Let's hope so. We'll keep our fingers crossed.
Right. I want to thank you for watching. I hope you enjoyed the show and that you tune in again next time. Until, take care.
Welcome to Channel 17, the Town of Colonie Government Channel.